Hi all, good evening and welcome. I am Radil Mishra and on behalf of CareEdge, I welcome you to our today's discussion on our credit quality assessment for second half FY23, and we sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. We have with us Mr. Shankar Tripathi, Executive Vice Chairman, Aadhar Housing Finance Limited, Mr. Giridhar Sanjeevi, Executive Vice President and Chief Financial Officer at Indian Hotels Company Limited, Mr. Nitin Parekh, Group Chief Financial Officer at Zydus Lifesciences Limited, Mr. Rajkiran Ji, Managing Director at National Bank of Financing, Infrastructure and Development, and Mr. S.N. Singh, Chief General Manager at SIDBI. This session will be moderated by Mr. Sachin Gupta, Chief Rating Officer at CareEdge. We'll commence the session with the presentation by Smita Rajpurkar, who is a Director at CareEdge. This will be followed by a panel discussion and Q&A session. In case of any queries, participants are requested to please key in your panel. We'll be taking your queries in the Q&A session. Now, may I request Smita to make a presentation, please?
Thanks, Rudal. Hello, everyone. We welcome you to CareEdge Ratings webinar on credit quality assessment for the half year ended March 23. In this webinar, we will take you through our assessment of the credit quality of CareEdge Ratings rated portfolio in the second half of the fiscal. So the global economy, as we all know, has been facing headwinds. Has corporate India been able to dodge the global headwinds and sail through? What are the dampeners to the domestic growth? Let us deep dive into the performance of our rated portfolio to get answers to these questions. These are the key highlights of our today's presentation. The global economy has been facing headwinds. Exports are low due to slowdown in global demand. Spillovers from the Russia-Ukraine war, like rise in oil prices that we saw last year, inflationary pressures, weakening of the rupee, and volatile stock prices did have an impact on the global economies. A recent streak of bank collapses has raised further uncertainties on the global financial system. The US and EU GDP growth slowed in the quarter ending December 22 from the previous quarter. Amid these global uncertainties, India's high-frequency economic indicators point to healthy consumption demand. This is reflected very well in CareEdge Ratings credit ratio, which is normalized at 2.72 in the half year ended March 23, down from an all-time high credit ratio of 3.74 seen in the earlier half. While there has been a moderation, this is in line with our expectation, and we can say that the credit ratio is now normalizing as the credit ratio saw its peak in the previous half year. In the half year ended March 23 as well, the upgrades at 383 significantly outnumbered the downgrades at 141. Infrastructure sector's credit ratio saw an upswing to 3.10 in H2 FY23 from 2.24 in the earlier half. The credit ratio for the manufacturing and services sector has normalized 2.69 in H2 FY23 from its peak of 4.59 in H1. Similarly, the credit ratio for the BFSI sector moderated in the second half to 1.91 from 4.0 in the first half. With these numbers, CareEdge Ratings believes that corporate India has been a bright spot despite the global headwinds. Now let us have a look at the global economy with some broad numbers and how India's key economic indicators have performed in this backdrop. The global GDP growth is projected to fall to 2.9% in 2023 as per the International Monetary Fund, that is IMF, from an estimated 3.4% in 2022. While global inflation is projected to moderate from 8.8% in 2022 to 6.6% in 2023 as per the IMF, this is still very high compared to the pre-pandemic levels of about 3.5%. Price pressures, though moderating, continue to remain elevated, and central banks are on the path of monetary policy tightening, with the US Fed raising the Fed funds rate by 25 bips in the latest central bank meeting, taking interest rates to the highest level since 2007. The European Central Bank has also raised interest rates by 50 bips, taking its policy rate to 3%. Recent streak of bank collapses in the US and Swiss have also rattled the global financial system. In this backdrop, the Indian economy has managed to show resilience and is one of the fastest growing economies among its peers. India's GDP growth is estimated at 7% in FY23, which is the highest among its peer countries. Some of the high frequency economic indicators point to healthy consumption demand. We will go through them in detail in the next slide. After CPI inflation is projected to ease to 5.1% in the current fiscal from 6.5% in FY23, supported by a favorable base, fizzling out of pent-up service demand and the impact of earlier rate hikes. As we discussed earlier, the slowdown in global demand has affected merchandise exports. However, export of services and remittances have been upbeat and likely to continue so. We project current account deficit, that is CAD, to ease to 1.6% of GDP in FY24 following an estimated 2.1% in FY23. Let's now have a look at India's high-frequency economic indicators. High-frequency economic indicators point to healthy consumption demand. The top left chart on the Purchasing Managers Index, that is PMI for manufacturing and services, shows PMI in the expansionary zone, that is above 50 levels. While PMI for the manufacturing sector saw a dip in the last month, PMI for services has improved. The chart at the top right shows that e-way bills generation remained above 8 crore for the fourth consecutive month. The chart on IIP shows that industrial output rose by 5.2% YOY in January from 4.7% in December, supported by continued positive momentum. GST collections have remained above rupees 1.4 lakh crore so far this fiscal and grew 13% YOY to rupees 1.6 lakh crore in March. In the bank credit offtake chart, we can see that non-food credit rose by an upbeat 15.9% in February 2023, logging a double-digit growth from the 11th month in a row. Credit growth was steered by the retail and services segment with around 20% YOY growth in each, while the credit growth to industries was at 7% in February 2023. Credit to large enterprises accelerated to 5% in February 23 as against 0.9% growth in the same period last year. Thus, we can say that despite the expected growth moderation in FY24, the likely easing in inflationary pressures, improved CAD, and bank credit offtake and the upbeat high-frequency economic indicators signal resilience of the domestic economy amid the global headwinds. Let us now see how the performance of our rated portfolio has been in the second half of FY23. In this chart, we can see that the CareEdge ratings credit ratio has behaved well in the past decade. Credit ratio is the ratio of upgrades to downgrades. We calculate this ratio on a half-yearly basis. An increase in the ratio as compared to previous periods denotes an improvement in the credit quality of rated entities and vice versa. Credit ratio in the half-year ended March 23 was at 2.72. Which is the second highest ratio we have witnessed in a decade with 383 upgrades and 141 downgrades. The credit ratio was continuously on an uptrend from its low of 0.49 in H1 FY21, which was the pandemic period, up to H1 FY23 when it peaked at 3.74. The moderation in the credit ratio in H2 FY23 was in line with our expectations and the credit ratio is still at its second highest in a decade. We will now move on to understand the build-up of the credit ratio across the portfolio cuts. Here we can see that the credit ratios for both investment grade, that is IG, and below investment grade, that is BIG portfolios saw a moderation in H2 FY23. However, the IG portfolio's credit ratio continues to remain superior at 2.99, while the credit ratio for the BIG portfolio decreased to 2.22 in H2 FY23 from its peak of 3.54 in H1. The investment grade entities are entities enjoying ratings of CARE BBB minus and above, and a superior credit ratio for this portfolio indicates that our investment grade portfolio has indeed exhibited higher resilience, while the moderation that we see in the overall credit ratio can be more attributed to the BIG portfolio. This slide shows us the percentage of upgrades and downgrades to the total rating actions over the years. In this chart, we can see that in H2 FY23, upgrades constituted 15% of CareEdge rating actions, while downgrades constituted 5% of the rating actions. Thus, the percentage of downgrades to the total rating actions have remained the same as in the earlier half at 5%, and hence we can clearly conclude that the moderation in the overall credit ratio can be attributed to lower proportion of upgrades in H2 FY23, with the percentage of upgrades reducing from 19% in H1 to 15% in H2. Let us now move on to the sectoral trends in our credit ratio. CareEdge Ratings credit ratio for the infrastructure sector has seen an upswing in H2 FY23 to 3.10 from 2.24 in H1, driven by high number of upgrades in the power and transport infrastructure segments. The pace of upgrades in the manufacturing and services sector has moderated, with the credit ratio moving down to 2.69 in H2 of FY23 from its peak of 4.59 in the first half of the year. But upgrades continue to significantly outnumber downgrades. Credit ratio of the BFSI sector also moderated to 1.91 in H2 FY23 from 4 in H1. While number of upgrades continued to be high, downgrades increased in H2 FY23, pulling down the ratio. We'll now briefly take you through the subsectors that drove the credit ratios within these broad sectors, our outlook on these sectors, and the key credit monitorables. Let's start with the manufacturing services sector. We can see here that the credit ratio for the manufacturing services sector, though moderated, is the second highest credit ratio in the past 5 years. 14% of the entities reviewed were upgraded, and the downgrades were only 5% of the reviewed portfolio. Higher upgrades in this period can be attributed to sustained domestic demand aiding revenue growth, some easing of commodity cost pressures, and deleveraged balance sheets. Despite high number of upgrades in the sector, the credit ratio moderated due to decline in exports amid weak global demand and volatile pockets of commodity prices. Sectors that led the upgrades were healthcare, auto, hospitality, and pharma. Our outlook on the overall manufacturing services companies remains stable, with domestic demand driving the growth going forward, leaner balance sheets, and government initiatives like the PLI scheme, Gati Shakti, etc., along with the China Plus One strategy that we saw that continued to aid India Inc.'s growth. The key monitorables, on the other hand, are spillovers from the Russia-Ukraine war, slowdown in the US and EU, inflationary pressures, and rising interest rates. Let us now move on to the infrastructure sector. The infra credit ratio surged to 3.10 in H2 of FY23 from 2.24 in the earlier half, driven by higher number of upgrades in the power and transport infrastructure segments. The upswing in the infra sector was driven mainly by a lower proportion of downgrades in the second half. Upgrades in the sector were mainly driven by commissioning of projects, especially in the road hybrid annuity segment and solar power generation space, improvement in collection efficiency on implementation of the EMI scheme in the power sector, robust toll revenue performance, refinancing of projects at better financing terms and structured financing avenues like InvITs, and improved liquidity profile for EPC companies. Power and transport infrastructure segments drive the infra upgrades, as we see clearly from the chart, and they have contributed maximum to the upgrades. Infrastructure entities are poised for a robust performance in FY24. If we talk about the power sector, thermal PLFs are likely to increase, collection efficiency is improving owing to implementation of the EMI scheme, and renewable tariffs are set to rise but shall remain competitive vis-a-vis conventional power. However, persistent headwinds are expected in execution-related challenges, regulatory uncertainties in key states, and increase in input prices. Transport infrastructure is also expected to have an enhanced revenue visibility with infrastructure pushed by the government. CareEdge Ratings estimates toll collections to grow by 25% in FY23 due to WPI-linked hike in toll rates and traffic revival. If we look at construction, EPC margins are expected to recover from FY22 levels with addition of orders at new rates and reduction in commodity prices from their peak levels. Rising interest rates may, however, impact the bottom line. Moving on to the banking and financial services sector. The BFSI credit ratio moderated from 4.0 in H1 FY23 to 1.91 in H2 FY23, hit by both lower proportion of upgrades and higher proportion of downgrades. But the ratio is still at its second highest level in the last 5 years and upgrades continue to rule. Key drivers for upgrades in BFSI were significant improvement in asset quality, scale of operations and profitability, and strengthening of capitalization through equity issuances, both public and private. Downgrades, on the other hand, were on account of some weaker companies experiencing a deterioration of their liability franchise and regulatory changes affecting entities in the unsecured personal loan space. In the BFSI space, the credit ratio is largely driven by the financial services entity. BFSI continues to be stable, strong in FY23 at around 15% and is expected to continue to remain strong, supported by better capitalization levels. GNPA, that is the gross non-performing assets ratio, is expected to move below the pre-AQR, that is asset quality review levels of 3.8% in FY24 after a decade. An increase in credit deposit ratio and thrust for deposits are, however, likely to impact the net interest margin of the banks in the immediate term. Rising interest rates also expected to impact interest spreads of NBFCs in the near term, with part of their impact likely to be offset by increasing operating leverage and reduction in credit cost. We have now broadly highlighted the key credit drivers and our sectoral outlooks. For a more detailed coverage on each of the subsectors, please refer to our full report, which we will be releasing on our website after the webinar. With this, we come to the end of our presentation and we will sum up our observations. Indian corporates have shown resilience amid the uncertainties in the global economies, with a normalization of the credit ratio in H2 FY23 at 2.72. We maintain our stable outlook on the credit side, aided by robust growth in domestic demand, deleveraged balance sheets, easing of commodity cost pressures, and government's thrust on infrastructure spending. The normalization in the credit ratio is thus expected to continue. Certain downside risks that we will remain cautious of are elevated inflation, rising interest rates, hiccups in the global financial system, prolonged slowdown in the global economies affecting our exports, and lastly, climate risks with untimely rains and fears of the El Nino surfacing. So all in all, we can conclude saying that corporate India has remained resilient amid global headwinds and has successfully managed to dodge them. But we continue to remain cautious. Thank you so much, everyone, for a patient hearing. Handing over to Mridul.
Mridul, are you there? Maybe if you can switch on my video. Hello. Yeah, maybe we can switch on the videos of all the participants. Yeah, great. Thanks. So thanks, Smita, for a short but quite an incisive presentation, and thanks to all the panelists that we have. I will start with a brief profile of all the panelists. We have 5 speakers today. I'll start with Mr. Shankar Tripathi. He comes to us from Aadhar Housing Finance Limited, where he is the Executive Vice Chairman. Mr. Tripathi is a postgraduate in chemistry from Lucknow University, and he's a certified associate of Institute of Bankers. Mr. Tripathi has over 39 years of commercial banking experience in various verticals at Union Bank of India. His overall experience in housing finance industry spans over 10 years in leadership roles, and under his leadership, Aadhar Housing Finance has grown to be one of the largest low-income focused housing finance company in India. A very warm welcome, Mr. Tripathi.
Thank you.
Then we have with us Mr. Giridhar Sanjeevi. He is Executive VP and CFO at Indian Hotels Company Limited. He holds a postgraduate diploma in business administration from IIM Ahmedabad and is a qualified chartered accountant. In a career spanning 30 years, he's worked across various sectors, including consumer goods, retail, alcoholic beverages, financial services, pharma, and hospitality. He's also won several awards and has been inducted as a member to the Hall of Fame by CFO India in 2021. A very warm welcome, Mr. Sanjeevi. Then we have with us Mr. Nitin Parekh. He's a group CFO at Zydus Lifesciences Limited, and he possesses more than 38 years of experience in finance, legal, and IT functions. He has, he's a CA, CFA, and MBA from IIM Ahmedabad. He served on the board of governors of Institute of Chartered Financial Analysts, ICFAI Business School, ICFAI University, and he's also on the board of many Zydus Group companies. A very warm welcome, Mr. Parekh. And then we have with us Mr. Rajkiran. He's the Managing Director in National Bank for Financing Infrastructure and Development, also known as NBFID. He was a former Managing Director and CEO of Union Bank of India with more than 3 decades of banking experience. Mr. Rai is an agricultural science graduate and also a certified member of the Indian Institute of Bankers. He's a winner of various prestigious industry awards, and he's also been conferred honorary fellowship by the Indian Institute of Banking and Finance. A very warm welcome, Mr. Rai. And then finally, we have with us Mr. Sanjay Narayan Singh. He is the Chief General Manager in Risk Management Vertical at SIDBI.
We can't hear you.
We can't hear. I think I'm missing the audio.
Can you hear me now?
Yeah.
Yes,
okay.
we can. Yes, we can.
Okay. Yeah. I'm sorry. I don't know at what stage I kind of, I kind of got lost.
Last maybe 20 seconds or so.
Yeah, we lost you in the introduction of Mr. S.N. Singh.
Okay. Okay. So not much damage. Mr. Sanjay Narayan Singh, he's the Chief General Manager of Risk Management at SIDBI, and he's a postgraduate in Business Management with specialization in Finance and Marketing from IIM Lucknow. And he has completed his bachelor's in technology from IIT Mumbai. He has over 31 years of experience in SIDBI, where he has headed various verticals like IT, HR, finance, treasury, and venture capital. So once again, it gives me a great pleasure to introduce this panel because it's quite illustrious and quite across the various segments of the economy. And for this session today, it is good to have people across the segments. Considering that we are focusing more at the economy level and not so much at the company or the sector level. So, the first question I had is, and that is something, a sector which has kind of seen, I would say, the maximum yo-yo or a delta, in the economy, and which is hospitality. And that is also that we saw in the presentation. It's one of the sectors which is driving the, large number of upgrades in manufacturing and services sector. So, Mr. Sanjeevi, and we can't have a better person than you to kind of, give us a sense. The question that we have is, is because you will be looking at the inflow and the footfalls of the, of your consumers or the, hotel consumers on a daily basis. The question that we have is that what we saw in the hospitality industry, is that something like a pent-up demand that we saw, or are you seeing sustainable demand thereof? Simply because we also see, while there is a growth in performance or improved performance, but we also see, overseas there is a bit of recession, and also domestically people say that travel has come down because of this not work from home, but maybe doing more Zoom calls as we are doing right now, and therefore people need not travel. So if you can give us a sense on that, that will be very helpful.
No, I think thank you, Sachin, for the introduction and your question. Yes, it's true that the hospitality sector has seen the maximum yo-yo. We have seen zero revenues to the peak results that we saw for the hospitality industry so far. Of course, I can't talk about the final quarter because of closed period and all of that. But nevertheless, I think the business continues to be strong for the industry. I think the pent-up demand itself is no longer valid. You can talk about pent-up demand if it was in a particular quarter, but consistently we have been seeing strong demand. And I think what has been great in terms of the demand is that despite foreign travel not completely coming back to India, even today, the growth in demand has been domestic led actually. So that has been one of the big discoveries for the hospitality industry in the last 18 months or so. And this is across all the segments, whether it is the corporate segment, whether it is the individual travelers, whether it is business travel, whether it is government travel related business actually, whether it is weddings, MICE, corporate events, all of those have kind of kicked off very strongly. And we have no reason to believe that this is going to be impacted. There is a certain K-shaped recovery that India has seen, and clearly as part of the K-shaped recovery, the luxury end of it has sustained, and we are continuing to see the momentum on this because I think if I look at the economic factors, you pointed out in your presentation about a 6% plus in terms of economic growth. So the macroeconomic environment remains pretty positive. That's number one. Number two is that within that, with all the efforts that the government is taking in terms of infrastructure development, roads, and I think the spread of development across the country, we are now seeing demand kind of being widespread and not just in the key cities. Actually, we ourselves are present in about 120 cities or so. The third thing is that the pandemic also impacted the supply, and I think new supply. I think overall industry estimates is that the supply growth is about 5% and the demand growth is about 6.5% or so. And I think that gap is likely to continue because new construction, even if it starts today, will take 3-4 years to come. And even within that, if you look at key cities, 5%, 7% numbers that I talk about are more macro. I think if you talk about saying, can I get a hotel in South Bombay as an example, there is no place for a hotel. So therefore, these patterns are accentuated. So first is the economy doing well. Second is the supply demand factors coming in. And there I would say that the demand is clearly surprising. And we believe that the long-term demand, not just the short-term demand, the long-term demand continues to be intact. So hence, I think the hospitality sector should do well. And the other factor to note, I think it came out even in your presentation, is that I think one of the questions that we have tried to explore also is the K-shaped recovery. And I think the services growth is very strong. And that is also helping the manufacturing, the demand for the hospitality industry. So we expect that it is no longer pent up and things are more sustainable. And the industry has also kind of learned its lessons from the pandemic, because one is about the revenue, but also on the cost structures, the industry has got kind of smart in terms of managing, at least in terms of productivity. And finally, I think some of us, of course, have cleaned out our balance sheets actually, and therefore the balance sheet is also delivered. And that is also helping. Though, of course, there are some hotel companies who still have debt on the balance sheet. But nevertheless, I think the growth in business is helping them. So overall, there are multiple factors which suggest that the hospitality sector will remain robust, actually.
Great. Thanks, Sanjeevi. One big takeaway, especially on the demand supply situation, as you explained, I think for all of us, it means that the hotel rates, room rates will continue to remain high, right? I mean, which kind of, all of us know, and especially in, the leisure places, right? I mean, places like Goa and all that, I mean, the room rates have actually doubled from, not long time back. So at least good for Indian hotels. Yes. Great. So let me come, from luxury and hotels, to more affordable housing finance, and that is Mr. Shankar Tripathi from Aadhar Housing. Sir, we are seeing, and there was general talk on, inflationary pressure being high, rise in the interest rates. What is your sense, on the demand outlook, especially in the affordable housing, what are we seeing there in a more recent basis? While we have seen the numbers have improved over the last 1 year or so, but are you seeing how is the demand appetite for your products, sir?
Thank you, Sachin, and thank you, Care, for taking me as panelist along with the other esteemed panelists. I think the demand for the affordable housing, first of all, we understand that affordable housing, when we are talking, the loans up to 25 lakhs and below, and largely the loans up to 15 lakhs or 20 lakhs or even less than 10 lakhs are the major factor of demand in the country, and they are in the mass market. They are not only confined to the 7, 10, 20, 50, 200 cities. They have gone to tier 3, tier 4, tier 5 locations. Last 1 year, the Reserve Bank of India has been increasing the interest rate from May 2022, along with the higher inflationary pressure which started. During that period, the demand not only for affordable housing, but the overall housing has been very good. And I tell you, January, February, March, you name any company, small or big, they have done fantastic business. It never looked that the demand in the housing has been dampening. It was just like as it used to be in 2018. That is what I have been in 18 also, now also. I have seen there has been the huge demand. Now, how demand will pan out after the March, and that is from April onward, rate cycle of increase of interest rate will be almost, I think, getting over by tomorrow. The last cycle will be there. And after about a year or so, probably there may be a reversal of cycle will happen. Now, inflation and the increase in interest rate, sentiment-wise, both have a dampening effect on demand. This is a very general thing, and it is but natural. But in the low-income affordable or in the affordable segment, there the cost of credit is never material for them. They always look at getting the credit for constructing their house. If they have demand for making a house for 3 rooms, they may make 2 rooms, but they will go for the construction of houses. That is one thing. Second thing, inflation has definitely caused a rise in about 15-20% in the building material cost. Even the builders have also started increasing the rate of the flat, but in the low income affordable, a lot of self-construction cases are taking place. There the cost has gone up. But that is getting offset by the increased amount of loan. And similarly, if the interest rate increases, the eligibility of loan comes down with the same repaying capacity because the EMI goes up. But both things can be counterbalanced by increasing the loan period so that the customer can get, suppose he was earlier constructing a house in 10 lakhs rupees. Today he requires 12 lakh rupees. So by increasing the loan period, as again 20-25 years, 30 years. Generally, we give loan up to 30 years. So that doesn't impact the borrowing capacity and repaying capacity both. The interest rate rise, what happened, what EMIs will slightly go about 300 or 400 rupees per lakh, that can be offset, as well as the rise in the cost of construction, both can be offset with the increase of loan period by 2, 3 years, 4 years, so that customers' repaying capacity doesn't get impacted and his requirement of the loan doesn't get impacted. So my sense is that in affordable housing, there is not going to be too much of dampening impact on the demand because it is the mass market loan, not for the confined market.
Got it, sir. Thank you.
March 23 financial year, probably the bigger companies might give growth about 12-13%. Affordable housing finance company give growth from 15 to 35%, depending on the size of the book. That is what my take.
Got it. Thank you, Mr. Tripathi. From housing finance, let's come to infra. Now, infra, if you notice in the presentation, is one of the few sectors where we've seen actually improvement in the credit ratio. And obviously, there is government focus on infrastructure development. There is in general, we've seen good quality investors coming through. Now, my question is to Mr. Rai, who heads the NBFID, which is in some ways new kid on the block on the infrastructure financing space. So what is your sense, with the global turmoil, while infrastructure is largely a domestic play, but because of global, do we feel that the fund flow to the sector, more both on the equity and the debt side, would that be affected? And in some ways, because we need a large capital flows to really, fund this infrastructure story. So the current challenges that we are seeing in the global economy, do you think that could kind of really slow down our growth on the infra, whether it is roads or, renewable energy, etc.?
Thank you, Sachin. There are two things we need to look at before we answer this question. First of all, more than 80% of the money spent on infra comes from public spending, actually. It is a public sector spending. There's only less than 20% which comes from private spending. The second part is we need to split infra into greenfield and brownfield. Whatever foreign investment we are seeing is only in the brownfield as of now. The most of the greenfield investment either happens through public spending or from the domestic institutions. Only when the projects get completed and when they reach a certain level of cash flows, we are seeing investment interest. With this background, I feel that the present global turmoil will not have any impact because the kind of funds which are interested in these kind of assets are basically fund houses having patient capital like pensions and insurance and that kind of funds, which are looking at really long-term and long-term returns. So actually this global turmoil and all these cycles are very temporary. So these are 2-3 year cycles which will come and go. Whereas these funds will always have a very long-term outlook and call on this. And India is the best place to be in. So everybody understands the way the investment happening and the kind of infrastructure growth what we are seeing. I think we'll create more and more assets where these investors will definitely keep coming in. And kind of returns what they get also is quite good. Another thing is the kind of enablements government has done. by way of dispute resolutions and the better concession agreements and the kind of structures like INVIT is one structure which is really helping deleveraging of completed projects, moving into much better structures with much better equity participation. So I think all these are helping, and I think with the kind of budget allocation which is happening for the infrastructure spend, and with the national infrastructure pipeline of more than 112 lakh crores, I don't see any reduction in investment happening in the infra space, and the global interest was always there, and our personal experience also while talking to the parties, I think this particular turmoil will not have any impact on the investment which is flowing to the country, and it will only grow. I think we need more and more infra, and India is in a sweet spot that way, with all the enablements in place, and with the more and more, like if you see the presently it is roads and energy which attracted a lot of investment. Right. As we go along, like the logistics, warehousing, multimodal logistics, and all these infrastructures connected to that, ports, airports, everything will attract investment. Now the latest new thing which is coming up is data centers. Data centers also is attracting a lot of investment. So I think India is becoming a hub for many of these activities, and the execution skills also. That is another thing, because in the earlier phase, actually we could see that it is not only the infrastructure investment, it is the execution capabilities of the companies also were not that up to the quality. But what we are seeing today is much better rated companies with better execution skills. The projects are also getting completed in time, and with much better quality. So I think everything put in place, I think India is in a sweet spot when it comes to infra.
Got it. Thanks. You gave quite a well-rounded overview, and I would agree. My only point here would be that maybe the ask of the global investors, their yield expectations may go up, because in general, if the risk-free rates in US is moving up to 4-5%, even in long term more than 3%, then maybe the expectation of returns could be different. But yes, in terms of quality of assets, I completely agree. They have now a good quantity and quality of assets where they can invest. So I'm also hopeful that they will kind of keep their wallets open to fund our infrastructure. Let me get Mr. S.N. Singh for SIDBI, and taking his inputs on the MSME side. That is a space which we always believe is, quite central to the growth of our manufacturing value chain. And there is a lot of impetus by the government, PLI schemes, etc. And at some level or the other, MSMEs are the ones who will provide the backbone. I mean, my question is really on the asset quality. Are we in the current, now that pandemic is done, and we are seeing some bit of upgrades that we are seeing across the manufacturing sector. But at your level, from where you are sitting, sir, how do you see that the asset quality of the MSME? Do you see some risks there in terms of delinquencies, etc., coming through? So you're on mute. Yeah.
Sorry. Yeah. The MSMEs have traditionally faced what we have seen in last few years, a number of challenges, whether that was on account of demonetization, introduction of GST, more recently COVID-19, but they have proved their resilience. In fact, traditionally, the MSMEs have outpaced the growth of GDP in the economy. What we had, particularly in the growth phases, we had seen that in the late 2000s, and more recently, I think they have had a healthy growth. Also, we need to keep in mind that with the access to the market which MSMEs have, there is one aspect, through the Amazons and Flipkarts of the world, and now through ONDC, there is much more, build of the resilience of the sector. Also, the MSMEs have become much more diverse on the back of technology, the opportunities which have come in. There's also the tech stack, which includes the UPI payment, which further enables the payment systems, which the MSMEs would clearly benefit from. Not only the access to the market through ONDC and that's Amazon and things like that. They build in the infrastructure, which have just been touched upon, particularly the road transport, the seamless integration of distribution across the country. Overall, I think the MSMEs are going to benefit. Of course, they face the headwinds, particularly from the external sector, in view of the slowdown and the traditional market of MSMEs. If we have to talk about textiles, for example, or auto components which are dependent on exports, that's where there is certain risk, definitely. And so also, in view of the vagaries of nature, as was there in the presentation, particularly the kind of monsoon which may be there now, or the spread of the monsoon, I think these are broadly the risk. But overall, in our experience, as also that of the public sector banks and private sector banks, the banking sector, the resilience of MSMEs have been quite strong. With growing Indian economy, they would continue to plug in to that growth. I think that's the perspective.
Got it.
Which
Got it.
I would have.
Thank you. Thank you. Let me get Mr. Nitin Parekh from Zydus. And pharma is fortunately a sector. I think they were making money when COVID was there. They are making money when COVID is not there. So, it's maybe one of the more stable sectors. But Mr. Parekh, can you give us some kind of a sense in terms of overall Indian pharma sector, especially on the API segment? There was this whole talk about reducing India's dependence on imports, and there was whole China plus one kind of a thing coming through. So are we, at the sector level moving in that direction? Do you think investments are happening where, on the API and, full backward integration is kind of happening? Over to you.
Yeah, thank you for this opportunity. So China plus one, I think the strategy started making a lot of inroads and being talked about openly, especially in the time of COVID. Where most countries, including India, believe that for essential drugs, you should not have dependence or a significant dependence on any other country. And the way China behaved, I think China plus one strategy was adopted by many other countries also. So when it comes to API, I think a lot is done in terms of PLI scheme, also in terms of incentives. Was about roughly about 7,000 crores of benefit of PLI, including additional 3,000 crores of bulk drugs. So all critical KSMs, drug intermediaries, as well as APIs, now are part of PLI scheme. What it has done is in terms of, reducing the dependence on imported API. So if I talk of statistics, almost about 70% of APIs in India are imported from China. Now, as per the government plan and with the additional incentive of PLI scheme, it is expected that out of this, about 25% reduction would be seen in next 5 years. And by the end of decade, the dependence will be from 70% to 35%. And the fruits of this is that out of some 53 odd APIs, 35 APIs have already been started manufacturing by 32 API manufacturers in India. And so that shows the rigor in terms of how the government is viewing the scheme and how the industry is adopted. And API, we as a country are the second largest in terms of volume globally. So that speaks about the backbone, and considering the patent expiry globally as well as better growth in India, double-digit growth that we are expecting. I think both for domestic as well as global market, Indian API industry would see a significant growth.
Got it. No, that's good. Even though I don't know now with China kind of waking up, the giant is waking up, after this whole zero COVID. So whether global investments would continue while the geopolitical thing is still, I would say, not so much in their favor. But now that they have kind of, the supply chain bottlenecks, etc., are kind of improving, whether people will really put the money in terms of investment instead of just importing. So that is something that we will have to see. Obviously, India has a more strategic interest in terms of, more of self-sufficiency. So perfect. So let me get in, on Mr. Rai, for this, one of the reasons why we had a high credit ratio for the infra was the improvement in the performance of thermal power assets. Now, that is a sector which, pretty much everyone had in some ways kind of written off. There are hardly any fresh investments happening, only cases in NCLT which are being resolved and all that. But now with this whole EMI schemes, which was kind of launched, even the weaker discoms have kind of, honored, and, we are seeing, I think some 7-8 months have passed and mostly they're kind of honoring that. Now, we have seen a lot of schemes in the past, and generally they kind of appear to be more like, kicking the can down the road. From where you see, and you will be looking at this sector, I'm sure, much closely. What is your sense? Is this kind of a sustainable improvement in the credit quality of thermal players, or do you think this is just one story which is good enough for a year or two?
No, Sachin, I think there's a substantial improvement and sustained improvement we are seeing even in state discoms. Even the whole energy piece, actually state discoms were the weakest link, actually. That is where we had a lot of problem, actually, while we fixed the areas of manufacturing and transmission. But I think state discom sitting at the last leg, actually, was a problem. We had some state discoms doing very well, but there are historical reasons why they are weak. So I think gradually, there were several schemes we can, in the last 10 years, to improve their efficiencies. Didn't work to that extent. But then what we see in the last few years is a substantial improvement in their working. Basically, even if you talk to the thermal power or other renewable companies where they have a counterparty, a state discom, the payments have substantially improved. One is, as you rightly said, the EMI scheme which came in. And added to that, there is another scheme called RDSS, the revamped distributions scheme, actually, which came from the central government. Basically, central government actually is nudging these discoms by way of incentives to improve their efficiencies, to cut down on the transmission losses, move more to the smart meters and kind of thing. Actually, the changes which are coming are actually more getting ingrained in their system. It is not that it is a book entry or something which is temporary and all that. So all these incentives are marked to particular efficiency improvements. It has to be shown that this improvement has happened. Actually, cutting the transmission losses, putting more smart meters and all that. Then only these incentives will flow. So I think this kind of push and nudge from the government for improvement is going to stay, and this will improve. Because actually, as we move towards more renewable energy coming in, we are talking of 450 gigawatts, 500 gigawatts. Everybody looks at a counterparty like SECI or NTPC kind of thing. So and they have a limitation. Beyond a point, I think they can't go. I think the state discoms have to come in. And we are seeing a qualitative improvement in many of the state discoms. And I foresee a substantial change in the way the state discoms operate and collect money.
So that is good to hear, sir. I mean, because while at some level this may be financial engineering, but what you are saying is that it is accompanied by actual improvement on the those transmission AT&C losses, and that can have a long-term impact in their efficiency and therefore their ability to pay the counterparties. So great. So next question I can get Mr. Giridhar Sanjeevi from Indian Hotels. What is your sense on the capex? While you did mention it takes 2 to 3 years, and therefore nothing will kind of come. So yes, for the next 2 to 3 years, the margins could remain good, and therefore the hotel industry could do well. And we also have things like ICC World Cup and IPL and all that, and maybe the international travel will also open up. So yes, the next 2 to 3 years is good. But are we also seeing more investments happening on the hotels, in new properties being built up? And what is your sense on that, sir?
No, I think yes. No, I think capex is happening in a couple of areas. So number one is the product upgradation itself, because I think the last couple of years in the pandemic, there was clearly product upgradation did not happen because companies were struggling with their own capital in terms of dealing with the pandemic. So I think in the last 1 year, we are definitely seeing renovation expenditures go up actually, and therefore the capex is going up. So that's number one. Number two is that there are clearly M&A opportunities which are possible because of consolidation, because of the end of the ECLGS schemes, moratoriums actually. So therefore, M&A opportunities are something which will definitely open up, and that will result in capex for sure, and resolution of bank debt as well, wherever there are challenges actually. As far as new hotels are concerned, I think we are also kind of signed up to some greenfield projects actually, which will not come immediately, but the commitments are being made and construction will happen over a period of time. So I think so some greenfield capex is something that we have also started doing, and clearly as the demand supply gap continues, see the reality is that some construction will start, and therefore you do expect some capex to come there. So these would be the broadly 2-3 areas, and certain regions are also kind of becoming important. Like for instance, I would say Northeast is seeing some activity. So I think you will certainly see the UP government development, what they've announced recently, that also will see activity. And as the state highways come in, smart cities come in, I think you will also see activity in terms of new hotels. Airports, for instance, will be a big area where new hotels will come up, whether it is Navi Mumbai, whether it is some of the other airports which are coming up. I think they automatically create capacity for new properties to come in, like the Mopa Airport and all of those. So I think there are a few reasons why new capacity expansions will come in, renovations happen, M&A opportunities. I think that's the way I kind of see it actually.
Great.
But I think it will happen. Yeah. The only final comment is that I think the spending on capex by companies will still, I think companies don't want to go back to their old leverage days during the pandemic. So I suspect that cash flows will be kind of moderated to ensure that capexes do not lead to unnecessary debt on the balance sheet actually.
And this you feel will be kind of evenly spread out across, say, the luxury segment, the 5-star, and then 3-star, 4-star more on the business hotel segments?
I think the lower ends are obviously easier because the luxury ends require specific locations and all that. Whereas in the economy segments, you fundamentally need a sensible business location. So hence, I think there will be more activity, I think, in the lower end than necessarily in the high end, actually.
Got it. Thank you. Let me get Mr. Tripathi. You mentioned, in your earlier response that the growth is quite good. And, for any NBFC, as you grow, you also need, kind of equity investments to kind of fund that growth. And as we generally discuss that, the global economy is kind of a little bit of a, they may be more careful in kind of allocating new capital. So what is your sense, for the industry? And maybe if you can look at NBFC as an overall space and not necessarily only housing finance, do you think the appetite that the industry has for new equity to fund their growth, would that be forthcoming? Because we are seeing a lot of private equity players, other global investors were funding that growth till very recently.
Now, Sachin, despite the global economy in the bad shape and a lot of geopolitical problems are going on, India's story, I can't say it is decoupled with the global economy, but it is intact. And everybody is looking to the India to invest the money. Private equity holders, they do not have depth of money, they have huge appetite. The only thing what is happening, they have become choosy because of the rising of interest rate. The flavor towards the lending companies has slightly gone reduced. But if you still see in last 3-4 months, there have happened couple of deals. A very small housing finance company also raised about 150 million, 160 million, and some mid-sized company of 5,000 crore AUM, they have also found the private equity holder, and NBFCs are also finding the private deals are happening. Private deals are not getting started, they are happening. Only the public deal like IPOs, these are not coming. And those private equity holders they have invested in earlier, they are now finding it difficult to have an exit route because of the dampening sentiment on the lending sector. Though growth is there, everything is there. And in India, the growth of NBFC and HFC is not a 1 or 2 years story, it is decades story. So I don't think that equity will be a problem. Those smaller companies are there, they are able to manage from the smaller deals, and those who are bigger companies, they are also able to manage. It becomes a function of how much multiple they want. So now if they earlier were they getting 5 multiple, they have to go at 3 or 3.5 multiple. But the market will again revive because in India there is a huge interest of everybody is there.
Got it. Mr. Parekh, let me come to you. And this is, we are now seeing that, more US FDA kind of visits have started. And in the past, at times the pharma industry has been a bit, shaken up by some warning letters and some other restrictions that these guys may put. And for some time, they were not coming through for the because of COVID, etc. So do you see that as a risk, and there could be some adverse action at the industry level, and that could impact the industry?
Well, it can happen from company to company differently, but I see this as an opportunity. The way many Indian pharma companies had certain regulatory issues in some plant or other, where some warning letter was there, and during COVID for almost 3 years there was no plant inspection. That also actually resulted in obviously not getting approvals for those specific plants, and then increased competition in generic in terms of the prices for the limited products that they were having. Now with the inspection taking place and some of the plants getting cleared, including our Zydus plant, let's say Moria plant got cleared after the inspection on warning letter. So for 3 years, we're not getting any approvals for that particular plant. So we have now got slurry of approvals all of a sudden, and so that works well in terms of our growth in US. So compared to many other peer pharma companies, we have been seeing a very good growth in US pharma. Added to that is also angle of specialty, where many of us, apart from the generic, and I'm not saying people are going for specialty, people are continuing with the generics, but adding niche segments of specialty, and like all the different companies have different philosophy to that. Sun Pharma has done a lot of investment in specialty in last 6-7 years through organic route also. A company like Cipla has got more in terms of in-house development of inhalers and complex injectables. Biocon is working on biosimilar as a thrust area, and Zydus we are working on various different kind of molecules, modified release products, injectable, complex injectable. We are also working on a specialty segment of rare and orphan disease segment, and working on our own research pipeline. So we already have one product called Saroglitazar, where we are conducting global trials and 2 indications. So different people are working on different strategies, but suffice to say that the good days for US market still continue and expected to continue.
Got it. Thanks for that. Let me ask this last question to Mr. Singh from SIDBI, and then we will open the floor for our participants to ask questions. Mr. Singh, in terms of growth, are there, and especially again on the MSME side, are you seeing any special segments, where the growth could come in the near future?
I think pursuant to the rebound in the sector, the kind of growth which is expected to be strong is, besides hospitality, it could be health and pharma sectors which are looked up for growth. There is also growth which is continuing in the services sector, including in all the sectors which are able to take use of technology, which could be even restaurant or cloud kitchens, which are linked to the Zomatos and Swiggies to be able to deliver their goods. I think while the economy is kind of not at a high growth pace at this point of time, but overall the MSME sector, except those which are facing headwinds because of exports, would continue to see a robust growth. We are seeing an all-around growth in all segments of MSMEs. I think that's Got it.
And I think also the whole PLI scheme, that will also ultimately percolate down to the MSME segments, right? Because they will be kind of supplying in a big way to the manufacturing, the larger companies.
Yeah, so the PLI segment, the PLI, the infra growth, the growth in consumption and disposable income with people, which is continuing to grow.
Right.
The credit flow is growing. For example, again, housing, and as Tripathi sir said, in respect of so linked to that is the construction sector. So except CRE, for example, which is continuing to see risk from I think lenders' perspective. So
Right.
the growth is continuing to happen in all the segments, driven credit flow through banks as well as NBFCs. Although NBFCs face challenges today.
Great. Great. Thank you, Mr. Singh. So now, Mridul, do you want to make an announcement for questions, even though I mentioned it? Maybe.
Sure, sir. Sure. So, dear participants, you are please requested to key in your queries in the panel provided. We'll take up your queries to the panel.
Yeah, I've already got one question. Let me just take that. Yeah, and this is for Mr. Giridhar from Indian Hotels. The question is the high and sticky inflation? This question is from Ayanti Bera. The question is the high and sticky inflation expected to impact hotel sector demand in near term? And how has the domestic demand been in this sector recently? So impact of inflation on the hotel demand.
Yeah, no, I think inflation is generally kind of good for the real estate and hospitality sectors, because I think demand, as I said, has continued to be strong. And in terms of even raw material prices and all that, while these may have gone up, we have been able to pass on the raw material prices through the banquet pricing and others. So in general, I think while inflation has been there, I think we have been okay in terms of the whole industry has been okay, is what I would say. Yeah.
Okay, got it. Thank you. Next question is for Mr. Parekh from Zydus. What is your take on price erosion and competition in the US generic market? Or is most of the price erosion behind us?
So price erosion in US generic market has been there historically, nothing new in that. In many years, earlier we were talking of 5 to 7% kind of price, erosion. But when the consolidation of various large customers took place in that particular year or 2 years, we had witnessed, depending on the products, even 10 to 15, 18% kind of price erosion. That is behind us. And we are now back to normal price erosion of about 5 to 7%.
Got it. Next question is actually a general question. Maybe Mr. Singh, if you can being the banker on the panel, maybe you can take that. The question is any major impact expected on the Indian banking system following the debacle of Silicon Valley Bank and the Credit Suisse?
While there are learnings from the failure of the Silicon Valley Bank and the Signature Bank, for example, or the Credit Suisse, what we are seeing, and that is essentially the interest rate risk getting transmitted into liquidity and capital risk. The banks in India are structurally quite different from these banks, particularly SVB and Signature Bank, in that their asset is significantly loan portfolio, which are typically floating rate, for example. So they will move with the interest rate, or they will get reset with movement in interest rate. A larger proportion of the liability side is insured rather. There is an insurance which is backing that. And also I think overall the regulation is much more conservative in India. Plus, there is RBI which conducts its stress test. That's our stress test on credit risk, and also they bring out the financial stability report, which kind of gives confidence to the various stakeholders. So I think those kind of scenarios not likely to, happen in India. Banks are expected to be much more resilient. In country, we have other bankers also on the panel.
I'm sorry, I made that comment. I'm sorry, I completely forgot.
Coming from the financial institution, the actual bankers face run on the deposits, but I think we are not going to face that.
Got it.
Much smaller banks, banks is a more riskier segment.
Correct. I forgot, Mr. Rai. Any thought from your side, sir?
Yeah, actually, we are not going to face a similar situation. Actually, if you analyze, Credit Suisse is a different case altogether. Actually, this was going on for some time. What kind of business decisions they took and all that. So it has got a different this thing. Whereas the SVB and Signature Bank, actually, it was more of a asset liability issue. The kind of risk management practices they follow. And the interest rates, see, when the interest rates move up, actually, the risk builds up in the system. So it may, show up in different ways. That showed up there. But the kind of Indian banking, like the kind of deposit mix we have, kind of regulations we have, we are not going to face that kind of problem. So we may not face that particular issue, but we may face other issues, but not the same issues what the US banks faced.
Maybe, sir, if you can hint on the other issues you're talking about.
No, actually, right now I don't see a challenge to the banking sector per se. But actually, see, one thing what we see is the resource mobilization for banks are becoming more and more difficult. Correct. So the deposit mobilization is not that easy. Interest rate on deposits are moving up, which will ultimately push the MCLRs of the banks. So, and lack of liquidity in the system is another issue. So interest rate moving up is a risk for retail and MSME segments, and some of the even infra projects which are very narrow IRRs and that they cannot take very high interest rate burden. So these are the things which we need to watch very carefully.
Got it. No, I agree with you. We also, at Care, and we have a large number of rated banks and other financial institutions, and we've also done this comparison or kind of, trying to do that. I think some of the points Mr. Singh mentioned and you mentioned, I think very clearly, I think the regulation in India is kind of more hands-on and more as compared to, say, what we saw in US, where some of the regional banks may not be under that direct regulatory supervision of the Federal Reserve. And even otherwise, I think the stress testing and the other tests which RBI has been doing in the past, generally, at least such kind of risks, I don't think we will have a problem with. They can always be, and we've also had cases of banks facing challenges on asset quality or otherwise. Those kind of risks kind of can always happen. But as such systemic risks, as we saw just from a balance sheet management perspective, I think those I would be very surprised if something like that happens in the Indian banking system. So great. So I'll just check if we have any more questions. I think that is it. We have also kind of overshot the time by a few minutes. So I would kind of take this opportunity to thank. I think we had a good, insightful inputs from all the panelists. It was a good that we could cover a large number of sectors across financial services, manufacturing, and infra, which gave us a good ringside view. I look forward to connecting with you again. And with that, we bring this event to a close. Mridul, you want to just formally close this, please?
Sure, sir. Thank you, sir, for moderating the session, and Smita for your presentation. And thank you again to all the guest speakers for the insightful views, Mr. Tripathi, Mr. Sanjeevi, Mr. Parekh, Mr. Rai, and Mr. Singh. It was a privilege to host you. And thank you to all participants for taking your time out and being a part of this CareEdge webinar series. For any further queries, you're welcome to write to us in the suggestion mail, which will be coming no sooner the webinar ends. I request the tech team to log off, please. Thank you very much.